Hello and welcome to yet another edition of Unleash Hour. And in this first quarter of 2022, like we said, we are focusing on how people are making money in various sectors, in various industries. And I'm glad to be joined today by none other than the CEO of AceMT. She'll tell us more about AceMT later. Rina, so karibu sana, and you can introduce yourself.
Thank you so much. I'm glad to be here. My name is Rina Namsia, and I'm a financial analyst, founder of AceMT Consulting. Yeah, it's AceMT Consulting, so I know the name confuses people, but yeah, with time, people will get it.
Okay.
So I'm so happy to be here to talk about matters money and finances so that people can get awareness on what to put their money in.
Yeah, so Rina has been in this space for a while, and that's why we are taking this opportunity to just have her come and talk to us a bit more about finances and much more specifically in the area of securities. Therefore, this is an exciting conversation because remember, at the end of the day, what we are looking for is to equip you with all the available opportunities in the various industries and sectors, so that as you're making your investment decisions, as you're thinking about how to take that coin an extra mile, you have all these options and you're not lost about where to start. So karibu sana, Rina.
Thank you.
And maybe we can begin this conversation with you telling us a bit about securities. You know, people hear about securities and they're wondering, what are we securing?
Exactly.
Yes.
Securing the bag. Okay. Securities are actually investment assets where one can put money in with the hope to get a return. So securities are actually a collection of different kinds of assets available in a financial market to invest in. Yeah. So you find that in Kenya, the securities market is called even the Nairobi Securities Exchange. It ceased to be the stock exchange. That's simply because it's no longer just trading stocks only, but trading other more types of assets. And so securities, the major categories of securities are categorized as equities, the fixed income securities, then you have derivatives, right? So for equities, those are the stock market, basically.
Yes.
Then we have the fixed income. Those are like lending types of assets, which are actually fixed bonds, treasury bonds, and treasury bills. Yes. Then we have the derivatives, which was introduced in 2019. So derivatives are something that I know most people do not understand what derivatives are, but we look at it as well. What actually it is.
Yeah, definitely. That's something we want to delve into a little bit more. So from the onset, it would be good as we continue with this conversation, how do people make money on securities? Because somebody is there and they're asking them, so I invest in stocks, how does it, how does this go about?
Yeah, how does stock work? Or how? Yeah, now for any investment, you have to understand how each class of an investment works, because each different types of assets have different types of risk and different types of returns. And so, for example, like when it comes to stocks, what you're investing in is a share of a company. So when you purchase a stock of a company, you are actually buying an ownership of that company. And when you buy an ownership of that company, you are privileged to be given a part of their profits, which is called a dividend. So every year, there are companies which share their profit earnings as dividends to their shareholders. Another way of earning from stocks is capital gains. That is like profits. So when you buy shares at a lower price and they appreciate later on, and then you sell them off, so that is a capital gain that you gain only. So those are the two basic ways of you earning from investing in the stock market.
Wow.
Yeah.
Awesome. So the stock market or the securities market is replete with many different opportunities. Can you maybe just shed a little more light on what opportunities are available in this market for people to make money?
Yeah, like I mentioned before, we have the stocks.
Yeah.
Then we have bonds, which are traded as a secondary market, because bonds are initially issued by the government as treasury on behalf of the government. They issue bonds. So on secondary markets, you find them at Nairobi Securities Exchange. And then you have the derivatives. Derivatives are actually assets that, as the name suggests, derive their value from an underlying asset. So you can find that a derivative, which is a Safaricom derivative, you can find an ABSA derivative. So those are assets that are mostly used to hedge, like to manage risks. There is a way you trade derivatives differently. You don't trade as stocks. So there are 3 different types of derivatives. Actually 4, which we have like futures, forwards, swaps, and options. But with the Kenyan market, we only have futures and options. So I don't know if I jump directly to derivatives and explaining them, but before I go to derivatives, for bond markets, once a government has issued a bond, there's a period where you can trade directly with the CBK. But once that window is closed, then the bond goes to the secondary market. That is where people who already own the bond want to offload it, or want to, because a bond most of the time is long term, and someone maybe wants to liquidate the money, so they list it on the Securities Exchange, and you can go there and buy it at the stock exchange. Now on derivatives, derivatives, like I said before, it's they obtain their value from an underlying asset. A simple way of explaining this type of product, like a derivative, is like maziwa mala is a derivative of milk. You get. So you find that when it was unveiled in 2019, we had a few counters which were listed to to offer derivative products, which were like mostly liquid counters. Those were like Safaricom, ABSA, KCB, COP. Those are EABL, BAT. So we have derivatives of those counters. So for futures, for example, for future derivative, this is where derivatives are mostly contracts, like between you and I. But this contract, I'm not doing it with you directly. So the NSE, that is where is coming in to help us do this contract. So when you do a future contract, it means we have an agreement of what price you're going to pay me of this kind of, we agree this counter is gonna sell at probably 50 shillings in future. So you write that contract and decide this is the money you'll give me on this particular date. So it's an obligation, you see. So when that date comes, you have to pay me that money, whether the price has gone to that to that price or not. But for me as well, I have to put in an initial margin of money, probably of like 10%, say, so that process can go directly to trading. So you have to open a different trading account with regulated like investment banks regulated by CMA for you to trade in derivatives. So there is more to learn about derivatives as well, because it's more it's a more riskier again than stocks, because it's a hedge fund, sometimes mostly used by institutions.
So what you're saying is a normal CDS account will not be enough for me to trade derivatives.
You have to get an account to open to trade for derivatives, because not all investment, probably you're trading with a broker who is not licensed to trade derivatives, you see. So you walk into a broker who is licensed to trade derivatives, and they open a trading account for you to trade derivatives.
Okay.
Yeah.
Okay.
Because you see, even when you want to buy bonds, you don't buy bonds using the CDS account for stocks.
Yeah.
Yeah. For bonds, you also open a different CDS account with the central bank.
Okay.
Yeah.
Okay. I get you.
I'd forgotten about how you can also invest in property at the Securities Exchange, and that is through rates. Yes.
Yeah.
Rates is actually real estate investment trust. So it's a trust. They actually operate like the unit trust and the mutual funds. So what rates do is they collect monies from different investors, and they invest this money into property. So for you, what you gain is part of profit. And something good with IRES is that they have to give 80% of their profits. That is a mandate they have to by CMA.
Yeah.
So all the profits they make, they have to give the shareholders
80%.
80%.
That's
The remaining
interesting.
20%. You see,
Interesting.
but we only have one rate listed at NSE. Which was listed, I think, in 2015. That is the Fahari, the Stanley Fahari rate. So it's an I rate. We have I rates and we have D rates. So I rates means it's an income rate. D is a development rate. Yes.
Yeah.
So when you put money into an income rate, it means these are already existing property.
Units,
it could be malls, it could be rental, retail, it could be commercial. So already existing. But for D, those are you're giving them money to go and
build.
Develop, to build. Yeah. So always, and D rates can always be moved to IRES as well once the development is done. So
Are
that's
there
another
D-rates
way.
in Kenya?
No.
Maybe. Okay.
No, we don't have D rates in Kenya. We do have them, but they are mostly left for the professionals. You see, because there's a lot of things that go on with investing into property that are not yet even developed, you know. So at NSE, what is listed there is only the IRET, which is the Fahari Stanley IRET. Only that one is listed so far. So when you want to, and you can start with as low as 3,000 shillings, I think, to buy a unit. So that's a way of you investing into property, of you owning a part of
to rivers.
To rivers without actually buying to rivers. You see,
yes. The investment now in today's world is not limited to being able to invest locally. So part of the diversification strategy for people would be to invest on a global scale. So what would you say about that, and what would you say to somebody who's maybe doing a lot locally, but they are now thinking
going offshore?
It's time,
Yeah. Now we also have offshore markets, that is investing out of just the Nairobi Securities Exchange. So we have Johannesburg just down here, South Africa. We have the New York Stock Exchange. We have so many other offshore markets. So nowadays we have agents who are licensed by CMA as well. So they are operating here in Kenya, and they can help you open accounts for you to trade directly in an offshore market. Previously, we didn't have such kind of agents, and it used to be really, really difficult for you to tap into an offshore market. But we have people who are doing that right now, and that includes Pepperstone. We have Scope Markets. They do that. We have FX. And they're all licensed by CMA right now. So you can just talk to them, and they'll be able to open for you accounts to trade in offshore markets. But like you had mentioned, this is someone who's doing a lot of local and wants to go offshore. That's the person who's ready to do offshore market. But if you're new to offshore market, I will just tell you start here, because there are so many dynamics with the stock exchange, the securities exchange market, and if you do not even understand our simple NSE, it could be a bit tricky for you to navigate into big, because those are bigger markets. Clearly, you see, those are actually bigger markets. So just start with these local ones, but people are different. There are those who learn very fast, there are those who learn take time. So the way you know yourself, once you understand the fundamentals of how to invest in a stock market, then you can jump into offshore market. Those agents I've just mentioned as well, they do trainings, they can take you through of how you can actually even pick good stocks at the So, and that means when you want to go offshore markets, be ready to learn a lot as well, because you're going to deal in stocks like Google, Facebook, Apple. You see, those are very dynamic
Tesla.
and very big, Tesla, and very big digital type of assets, let me say. So be ready to learn as well, because those markets are very active even than our own NSE here. Yeah.
So, looking back at history and thinking about the people who've been very successful in the investment game, what would you say has been the common thread that holds them together? What are some of the things that are common to them?
The most common thing I've seen is thinking long term. Because most people who have made it even in the securities market will tell you the failures they made and the losses they made initially when they got in, because there's a lot of learning, there's a lot of fluctuation in this kind of markets, apart from the fixed income side. But when it comes to derivatives, the stock market, there's a lot to learn, and markets are never just at one stage, at one point. So thinking long term enables one to be able to overcome some setbacks in the market. Because if you choose a really good counter, for example, in a stock market, and you know the value of this counter is really good, so as long as the prices might go down, but if you wait for the markets to correct themselves, you eventually reap the profits on it. But if you're a short-term person, of course, NSE the other day introduced day trading, but day trading you have to be very keen and sitting there on fluctuation, and you have to have high capital as well, because the changes in the prices are very minimal, you know. So if you want to actually make profit out of it, you need to put in quite a good number of money. So most people think long term. You'll be able to, but don't forget to check on the stocks as well, you know, because anything can happen to any company. You can have management problem, you have political problems can come in. So you'll be able to understand also your exit strategy and understand the risks, because if you do not understand the risk of anything you're investing in, you clearly will not be able to mitigate anything that comes forth.
Okay. So since this program is watched by people mostly who are just getting started out in life and all that, maybe the question that someone is asking is, what would be the simplest way for me to get started in trading securities?
Trading securities.
Yes.
The simplest way and the first thing to do is open an account, you know. For any investment we always say have a goal. That's the first thing you need to have in mind. When you have your goals set, short-term and long-term, a goal should not be your destination. It should show you your journey. And for short-term goals, whatever you put in short-term goals, not mostly what you put in long-term goals. So when you have your goals uprightly put and clearly formed, then you'll be able to understand, I can be able to go into the stock market or not. Because if your goals are short-term, then probably the stock market is not where you need to start from, you know, because stock market, like I said, you need to think long-term. So if you think like 5 years, then that's something that can tell you, I can go to the stock market, because in 5 years' time, probably this is the right time to buy the stocks, because the prices are down. In 5 years' time, there'll be a correction, and maybe I'll be able to rip off my money. So the first thing to do, and you can invest with as low as 1,000 shillings, because all you need to do for a stock market to open is a CDS account, which is free to open. So once you open a CDS account, just do that. Most brokers and investment bank are now offering M-Pesa services on mobile services. So you just deposit the money in the CDS account as you continue learning about the market. And when you find a stock that you can afford and you know it's a good stock, then you just as well just trade by yourself from your phone, from your laptop, or talk to someone who is a professional to guide you to buy. When it comes to the bond market and treasury bill is a bit capital intensive, mostly to lower income people. So because the minimum for treasury bonds is 50K, for
Yeah.
infrastructure bond is 100,000.
Yes.
So that can be a bit high. But a way of you getting into exposure into a bond market is through the money markets.
Yes.
Because most money markets are mandated to put their money into the bond market because of its short-term needs and liquidity and security as well. So if you want to get exposure into the bond market as well, just start off with the money markets, which is very secure.
Okay.
Yeah.
So by money markets, you're talking about money market funds?
Money market funds, yeah. Money market funds, you open a money market account with a money market fund. And most of our investment firms have like the insurance companies.
Yes.
People do not know insurance companies are the fund managers of money market.
Yes.
So most of them, even the investment brokers, they offer money market products. So you just walk in with as little as 1,000, some with 2,500, some 5,000, whichever you choose.
Yeah.
You're able to expose yourself to the bond market. Yes.
Awesome. What are some of the dangers or pitfalls that somebody needs to watch out for when they are going into the securities market?
One thing is the risk.
Yeah.
Understand the risk of the stock market because it's a volatile market, and some of the risks of the stock market is we call it a market risk. This is the general economy lookout.
Yeah.
So you look at the whole thing, and and market risks are affected by things like the political, geopolitical nature. Like right now, we are going into politics, so those kind of things affect the stock market. Also understand risks like specific counters that you go to choose. Get to understand a counter before you choose it. What are the risks involved in it? How is the industry that particular company is in? Is it an industry that is failing? Is it an industry that is in technology, which informs you that that's a good stock because the prices will probably rise? So understand the risks first before you start jumping into what are the returns, because high returns means a high risk.
Yes, yes.
So if you're just anticipating of the risk, you're missing out on what you're supposed to mitigate. You're not looking at what are these challenges I'm facing for me to get these high returns for you to mitigate them.
Yes.
So the basic thing I say with the stock market is check on the risks that are involved in the whole market and in a particular stock that you want to pick. Yeah.
Wow, yeah, because we've seen people buy into stocks and then 6 months later you don't want to look at that number.
Yeah, I remember there was a time I was putting up a class and someone on social media, someone commented and say, I can never do the stock market again. So I understood him actually, because he's not the only one. So many people have put money in the stock market and failed. But from his talk and his bitterness talk, I would know he actually went into it probably because of pressure or because it was trending a particular stock or something. They did not look at the risk that come with that kind of stock, and they probably did not think long term. You see, so those two things, if you don't look at them well, then you can actually just go with FOMO, which is fear of missing out, and you might jump into something that is gonna take away your money. Yeah.
Wow, so FOMO is a big issue that I'm hearing over and over and over again in these conversations, that people do not need to go in based on their fear of missing out, that you need to do enough research. You need to be clear about why you're going into this particular thing, just to mitigate the risk. Yeah, because I remember in 2007, I think that's when the Safaricom IPO was...
2008, yeah.
It was 2008,
Yes.
Yeah. So in 2007, I think Kengen, was it Kengen that had done their IPO?
The IPO, yes.
And I think the outcome of it was that everybody who bought the Kengen stock, when it now started trading officially on the NSE, the price kind of shot up almost immediately.
Yeah.
So, it was very interesting. I'm one of the people who bought Safaricom. So I will admit that one of the reasons why I bought was I thought we would sell very quickly once it once it started trading. But it starts trading, and we were buying them at 5 shillings. It went at it started at 8 shillings and dropped
to 2 shillings.
To 2 shillings. So we were like there holding our heads and wondering, now where will this one go?
And most people got out.
Yeah, people got out, but I didn't.
Okay.
I decided to stay. Actually, I liquidated my Safaricom shares last year.
That's a good.
And that was just because I needed that money to take care of something. So, like you're saying, the long game is very important.
Yeah.
I wouldn't say my decision at that time was very smart, but thankfully I didn't have pressure with regard to the money, so I let it stay.
Yeah, and you see, another thing most people do wrong when it comes to the stock market is leaving when the prices are going down instead of coming in when the prices are going down, you see.
Yes.
And then they want to come in when it's now trending and going up.
Yes.
It's supposed to be vice versa, you see. Especially like right now when you hear a stock, the market is actually being affected politically and the interest rates of the market, inflation is coming in. So this is the time to look at the best counters and buy the counters, you see. But if you're waiting for them, and it happens all the time, when the prices now start shooting, everyone else talking about it, now what people want to come in, you see. And probably you're coming in when it is at the peak.
Yes.
So you buying and then it will drop. You see.
Yes.
So that's one thing people need, like determine your exit and entry strategy as well when it comes to the stock market. And not necessarily my exit and entry is your exit and entry, you see. When you have your goal, from the word goal, like I said, when you have your goal, your entry to the stock market is to make 50% out of this stock. So, and someone else wants to make 100%. That's a high risk taker.
Yes.
So once you make your 50%, you have your exit strategy, and you exit, you see, and you put that money into another stock, or you put into another kind of an investment or a need, like you said. But someone else who's a high risk taker is waiting for 100, and probably a high risk taker, they know their moves, they know probably they're holding or not. So know your entry point by understanding your goals as well. That's the basic thing.
Wow. Yeah. Interesting.
Because people who held on Safaricom, I actually get why people left early in Safaricom. During that time, I also bought the IPO.
Okay.
During that time, I don't think most people knew what they were doing. People were just buying the IPO.
Yes.
You know, it was the thing.
It was the hype.
Yeah, there was no literacy about what is a stock, why am I buying a stock. So I understand why people even left early. People are like, I know this deal is like a scheme or something, you know. Yeah, but that's why I'm even in this business, to make people understand what is a stock market and how it works. Not necessarily when it goes down you're actually making losses.
Yes.
Yeah.
So at a personal level, you've already spoken about Safaricom, but at a personal level, what other experience have you had, whether good or bad, with the securities market and the securities business?
The securities business.
Yeah.
I've had my good share of bad moments. I bought into a stock that I thought would actually appreciate to a good price, but it kept on going down. The dip. We say always buy the dip, but not always buy the dip. Yeah.
Some dips are too deep.
Some dips are too deep, and then you see that's why the market is a riskier market. Because sometimes you do all you understand your fundamental analysis, you really understand the stock, it has good management, all the good things that you're supposed to look at are there, you've ticked all the boxes. But then something out of the blues happens, you see. So, and when you look at the future of that company, you clearly see the future is not really good. However, whatever happens, I don't think there's going to be a good future for this. So you just count your losses, you know, and you put in your money there. That's why from the word go, you have to invest in money that you can afford to lose.
Yes.
You see? And then another thing I've also done wrong was to also invest some money that I was to use it in a short term, you see? So an emergency comes up and I have to exit before I make my money the way I had wanted to, you know. So I've also learned to just have in my budget, I have money that I know I throw there, money that I know I'll buy stocks, or I'll one day buy a bond worth millions, you know. I just have that money aside so that this money that I'm investing, I'm not gonna need it for an emergency or something. So I've also learned that.
Wow.
Yeah.
Awesome. They say there are many different types of investors, especially based on risk profile and all that. So maybe you can say something about that, because somebody could be there and they don't know where they fall and what maybe would be best for them, because we don't want somebody buying into something and then they start having nightmares because, hey, what is happening?
What is happening?
Yes.
You're not sleeping at night.
Yes.
Okay. Risk, when it comes to risk profiling, also, you know, I do also financial planning for individuals. Yeah. So I've had clients whose risk profile has been really low, but I've worked with them the journey, and at some point they could gain the confidence of actually taking up a portion of some risk. So for me, I think I've come to understand risk as something that you can actually embrace with time as well. You don't need to jump in outright from it into something, because, and mostly risk comes out of fear. Fear of risk comes out of, am I saying that, making sense? Like, and why do you not, why do you fear taking risk? It's because you do not understand something. You just hear from people saying, this happens like this, I failed in this, I put money in this, it has gone south. But if you take your own initiative to be financially educated, like, that is also an investment, to invest in yourself, invest in knowledge, understand how the real estate market works, what are the challenges in the real estate market, understand if I'm buying in a bond, what are my returns, what are the risks involved in the bond market, if it's a corporate bond, if it's in the stock market. Once you understand these things, you even get, it's like in a normal class, even in mathematics, you know, when you're able to conquer a certain equation, you no longer fear even the teacher asking you go to the board and do it. You know, you majestically walk and do the, even maybe you might even get it wrong, you see, but you have the confidence of taking that kind of a risk. You know the process. So educating yourself financially is the most important thing people need to do when it comes to risk, because risk profiling, for me, I think people can learn to embrace risks with time. I've seen it, people just being so closed up. I cannot touch stocks, but if you introduce to them slowly and you help them pick the right stocks, they're able to go to pick up such kind of stocks. And then another thing I would like to say about risk profile is, once you understand your risks profiling also has to be aligned with age, you know. As young people, we have the capacity to take in a bit more risk, significant risk than older people. Why? Not that older people cannot take risks, we have those who do it, but that is because they have the money they can afford to lose, you see. But with age, you are at that particular age where you're probably going into a retirement kind of a bracket. So that time you have so much need and you need so much cash flow to you as a person. So when you put in money that can get lost into assets that can get lost easily, or you put in money that you may need in your medical fees or something, you know, as an older person. So that's why your risk profile as an older person has to now go lower. You now need to shift from putting a lot of it in stock market and derivatives probably, and put it into the bond market, because that is a guaranteed kind of an investment, you see, with a regular return. But as a younger person, you have the time, like I said, when you think long term, you have the time to make mistakes and correct the risks. And you also have the energy sometimes to not sleep at night when you think about the stock that is going to fluctuate.
So we've had people who've been career investors, the likes of Warren Buffett. 6 decades now.
More than. I don't know why he's not retiring. He should retire.
What would you advise someone who wants to follow maybe a similar path?
Warren Buffett's way of investing is value investing. And value investing is picking out those stocks that you know are undervalued like they're trading at their lower price than what the actual fair value of the company, of the business is.
Yes.
So he picks out those kind of assets, and then once they go up, he does his thing, he makes his profit.
Yeah.
That's a good way of investing, value investing. But we are in an era where we are in a digital era, and even some businesses are astonishing some people, like people expect some businesses to make profits after some time, you see, like 5 years. But we have these technology companies that are coming up that they're breaking even in 2 years, in 1 year. You see, those are because we're in a digital era.
Yes.
So in this kind of an era, I would say, yes, it's good to be a value investor, but then again, look at not all principles of the years before actually even work today. Yeah, you might get stuck there because some of these stocks, which might be termed as good stocks for value investing, might not appreciate. You see, so you need to understand the kind of stock you're picking. If it's in the tech, it's in tech probably. You see, and you undervalue it, and you or you ignore it and say this other counter is a good for value investing, is more stable and all, like Warren Buffett says. You might miss out on this other one. So just look at the markets, how they are changing, and just get to understand we are in a digital era, and not all principles of Warren Buffett can actually apply today. So as much as you even want to apply them, but make them apply now. Make them apply in this era, not as as
they used to.
As they used to, yeah. Not everything is stagnant, and we have to change. If you don't change, they say change will change you.
Change will, you will be overtaken. By events.
Because a value investor is more of a very conservative type of investor, and as if you be a very conservative, sometimes you might not reach your goals sooner, or you might not even reach your goals. So you have to play in taking in more risks and trying out these tech companies that are coming in. Also invest in other businesses out of the ones which are listed at the NSE market. As long as you do your due diligence.
Speaking of which, there are a lot of there are people who have started now doing corporate bonds. This maybe has not been very common in Kenya, but it's now gathering steam. So what would you say maybe about that as well?
The corporate bonds. We had EABL issuing one late last year. Was it a 5-year bond or something like that? Corporate bonds are bonds. They operate just the way treasury bonds. The structure just the way the treasury bonds are, but the difference is the risk profiling of the two is different. You see, because this is a private entity, and a government bond is
guaranteed.
It's guaranteed. Your returns are actually guaranteed, and whatever happens with the government, it has to go towards to even pay you. It must pay, but with the corporate bond, there are other risks that are involved in corporate bonds, which you need to look at and understand. This bond that I'm buying, this company that I'm buying which type of a company, how are their earnings, what is their future. You need to really, really understand deeply that company, how their debt to equity ratios. You need to analyze that company in a good way to really understand that I'm putting this, because you find that the rate at which corporate bonds pay their interest is higher than the government bonds. Why? Because higher return, higher risk. You see, again, it plays there. So it means there are risks that are involved in corporate bonds that are not really in the government bonds. So understand it, especially on the company earnings, and understand the financial statements of that company and the long-term game. Because you may just put something in money and get to understand why they issuing a bond. Because that is borrowing money from you. From the public, what's the purpose of this money that you are giving them? Like I just can't come to you and ask you for money. You have to ask me for for what?
Do you have some 2 million somewhere?
Yeah, for what? You know, I have to explain and how you're gonna repay it back. And if you say you're gonna repay it back this and this way, you know, show me how you're going to do that. You need to understand all that before you put your money into it.
Yeah, because I can imagine what would happen if the company goes under. We've seen companies that have on the surface they are doing well.
Yeah, but
then the CEO exits and you realize all manner of things.
Yeah, like there's account at the NSE. We're really waiting once the CEO is out. What will happen? It's really doing really good. I'm not gonna mention it,
I
but
know. I know. Yeah.
we're waiting what the CEO is out. So that's part of analyzing a company, because part of analyzing a company is analyzing the management, not only numbers.
Yes.
You have to analyze how the management works, what are their policies, you see. So if if one person has a lot of power, if this person something happens, exits, so what happens to this company? And you know, when a company like a corporate company goes under, when it's liquidated or something, the last people to be paid are who?
Shareholders.
Exactly. So you need to you need to understand what you're getting yourself into first. Yeah.
Wow, awesome. Yeah, so far so good. Maybe it's now time for you to talk to us about AceMT and what you people do and how somebody can benefit from the services that you have to offer and how they can reach you.
Okay. Now, AceMT Consulting, we are an advisory company where we do trainings for individuals and institutions on financial literacy matters mostly. Yeah. So we do train people on personal finance. We do train on basics of investments. Another thing that you do is also offer advisory services on which kind of investments you can make in the financial market mostly, you see, because the financial market is where people do not have much knowledge and are not sure if they're able to do it. So we offer advisory services on that. And then we do also offer financial planning for individuals.
Yes.
Yeah. So you have money, probably you have high cash flow, but you do not know where to invest in, or you've invested before, but you just want to put your money in order for a long term. So that's a service. You can come to us, you can talk to us, and we'll be able to sit down with you and have a plan, a long-term plan for you and your money as well. So for business people, we offer also financial literacy for business people. And this basically means we do train business owners, especially mostly small business owners, on the kind of records they need to keep, the kind of statements they need to make, because most business owners right now are not people who even went to a finance class, you see, but understanding a business in terms of numbers is really, really crucial, because at some point, as much as you can ignore it, at some point the numbers come into play, because there's care, you need to pay taxes, but you need to understand your obligations. And if you do not understand anything numbers about your business, then you're not able to meet your obligations when it comes to things like care, or even if you want to get an investor, you need to have your finances in order. So that's another thing we offer for the small business people. And you can always find us on Facebook for AceMT Consulting, on Twitter, the AceMT, and then on Instagram as well, the AceMT. And you can we have a website on acemtconsulting.co.ke. You can give us an email at info@acemtconsulting.co.ke. And then hit us up on WhatsApp, or you can call us on 0759 798852. Yes.
Awesome. So there you have it from Rina from AceMT Consulting. Yeah, everything basically that you need to think about when you're talking about stocks and securities. So again, as I always say, it's important that you pick 1 or 2 points of action for yourself. You go out there and you start taking action on that investment journey. Because in 2022 and beyond, we must make money, and we must find all the ways and means through which we can do that as we maintain our sanity. So thank you so much, Rina, for that. Maybe what would be your final parting shot? You can just look into that camera and yeah.
My parting shot will be, I'll just echo his words. Planning, you can plan forever, but when it comes to investing, especially in the security markets, take action. Just start. You will learn along the way, because sometimes people want to learn a lot. And when you put your mind into learning a lot, sometimes without putting in the action, you get confused, because sometimes theory is different from practice. So just start. Just jump into that. Open your CDS account. Open that money market account. If you want to do a business, just start it. Because sometimes you might wait to be perfect, to know everything, but you might never get to that point. You will learn along the way. So let 2022 be the year where you actually invest money, not just save money, because inflation is there to eat into your savings as well. So learn different types of assets available learn different kind of assets that you're able to invest in. That is, if it's in real estate, if it's in property, if it's in the stock market, come to us. We'll talk to us. We'll be able to guide you through. We'll be able to make you understand how the stock market works. If you want to put your finances in order as well, talk to us. We'll be able to help you go through it. Take action. That's really my parting shot.
Thank you.
Yes.
Thank you. We bring this to a close at that point.
Okay, thank you.